And good morning once again, options traders. Happy Wednesday. It's hump day, and I've got another good topic here for the group, and that is on hidden opportunity costs. And I see this problem a lot. I get emails on it all the time. It mostly comes up when we're doing our hedges, rolls, and morphs, some of our favorite techniques with options, but you have to understand these opportunity costs, otherwise you'll make bad decisions. So, what's this all about, this idea of hidden opportunity costs? Well, let's go find out more. And as always, before we do, please be sure to click like and subscribe. It's greatly appreciated and definitely helps to promote the channel. So, let's do a simple example with a long call. Let's say that you buy a $100 call and you spend $5 for this call. Later, the stock rises to, let's say, 105. And it turns out that you can sell the 105 strike for $5 as well. So you're thinking, hey, I could leg into the 100-105 vertical for zero. And that's because I've spent 5, I collected 5, so now I effectively have no money into the trade, and yet I'm holding this long 100-105 vertical that can now make another $5. So I have the ability to possibly double my money, right? I started off by paying 5, and I might make it grow to 10. But worst case is I just get my money back. I end up breaking even. So this is a morph where we've just altered our risk graph from a long call to a long 100-105 vertical. But the question that we want to answer right now is, do you have a zero cost basis with a possible $5 gain? That's really the question. And this is what's going to dictate whether we decide to do it. And a lot of traders say this is great. I can possibly, again, double my money. I've got really no risk, at least in terms of the original principle. But is that really true? So here's the way that most traders look at it. They'll say, I start off with a $100 call with a max loss of 5. And if I sell the 105 call for 5, what I've done is I've transformed or morphed from this black line into this red graph right here. That's the long 100-105 vertical for no cost. That's why the lowest point on this red curve lines up at 0. However, you can see over here a maximum gain of 5. So it looks like we could double our money. We started off paying 5, now I might make another $5. But again, if everything goes wrong, worse is that I just got my money back. Is that really true? Because we need to answer this before we figure out if it's a good deal for us. Well, this isn't really true. It looks like it's true, but it fails to take into account the opportunity cost. So what's that? Well, in economics, an opportunity cost is the next best alternative use of something. So as an example, let's say that you quit your $100,000 a year job to start a business. And, get lucky, you earn a $100,000 profit in your first year. And so the question is, what's your accounting profit? If you went to an accountant's going to say, well, you've got a $100,000 profit. But how would an economist answer this? An economist is going to say, let's talk about the economic profit, not the accounting profit. What actually happened once we account for things you had to give up? So in this case, an economist would say, well, yes, it's true that you made $100,000, but you also had to give up $100,000 to be able to make that $100,000. So it's as if you took $100,000 from your left pocket and just shifted it over to the right pocket. It's pretty hard to say that you were better off. So your economic profit is 0. And that's because we're taking into account this opportunity cost. In other words, we had to give up this opportunity, the previous job, in order to take this opportunity. And so this is the piece that so many traders miss. So to understand, let's go over to a pricing model and get some prices. Okay, so now we're back into this pricing model that I've been using recently over at option-price.com. And let's put the stock at 100, the strike at 100, 60 days to expiration, no interest or dividends, 31 volatility. Now I've chosen this odd sounding volatility number because that basically makes this call price $5. And that's what I used in the presentation. So we're assuming that we start off paying $5 for this call. Now remember, we're assuming that the stock rose to a level where we could sell the 105 call for 5. So let's take a look at the 105 strike and start moving the stock price until we can get that price to become 5. So we can see the 105 call is currently trading for about 302. So if we bump the stock up, let's say to 105, it's worth 526. So maybe we take some time off the clock. Let's try 54 days. There's 499. So pretty close. So here's the situation. We start off with 60 days to expiration. 6 days have gone by. The stock has gone up to 105. And now we say, hey, look at this. I can sell the 105 call for 5. And that's allowed me to go into this risk-free vertical spread. But here's the part that people forget. What else could we have done with that 100 call? See, in order to leg into the 100-105 vertical spread, we had to give up the opportunity to close the $100 call. We're choosing to use it to now stay into the position, albeit with a new profile with a vertical spread. But we need to say, what could I have done with that call? So with the stock at 105 and 54 days to expiration, let's go back to the 100 call, and we see it's trading for $7.77. Now, just to make the numbers round and easy to work with, I'm going to call it $8. But this is the part that everybody misses. See, we could have sold this for roughly $8. We've chosen not to in order to leg into the vertical. And so now with these prices, let's go back into the presentation and look at how things actually changed. So this was the kind of the free 100-105 vertical that we saw before. Lowest points lined up at 0, but we're thinking we could make a maximum of $5 or double our money. But now that we see the opportunity cost, I could have sold that $100 call for $8 roughly and then pocketed this $3 profit right here. So let's put a flat line at 3, because if I had sold that call, I would have that cash sitting in the account locked up. No matter what happens to the stock prices, that cash is not going to change. So see, now we get a different view. It's not that we can make another $5. We could make another $2, but it comes at the risk of potentially losing 3. That's a very different picture from what we thought before. Now, granted, the stock is up here at 105, so we've got a fairly good probability that we're going to see some extra money here, but we also have a pretty good probability that we could lose. So the thing to understand is we have to account for this opportunity cost. Now, another way we could come up to the same conclusion is to say, what's the market value of the 100-105 vertical? So with the stock at 105, the $100 call we found was worth 8. If I wanted to buy that 100-105 vertical right now, I would have to spend 8 on the 100 call, and then I could sell the 105 call for 5, so it would cost me $3 for the 100-105 vertical spread. So see, this is the hidden part. Just because you didn't spend 8 for this $100 call, people are assuming that it has the original value of $5. But remember, the price you paid has no bearing on its value. Right now it's worth 8. And if you're choosing to not sell it, you're giving up that opportunity in order to use it as part of the spread. It's as if you're spending $8 on that call. And that's why we end up with this possible loss of 3 and a maximum gain of 2. So again, this is not saying that hedges, rolls, and morphs are bad. Those are one of the main reasons that we use options. They allow us to more efficiently manage risk as market conditions change. But if you're making these changes to your positions for the wrong reasons, in other words, because you don't really understand the max gains and losses after accounting for the opportunity costs, you're going to make bad decisions. So the main thing to take from this is that every decision has an opportunity cost. And if you don't know the opportunity cost, think carefully before placing the trade. The true cost is probably hidden. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a candlesticks and technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.